Charlie Munger never chased high-yield monthly dividend stocks, not even the tempting ones paying around 5.8%. And he had a brutally simple reason. Most high yields aren't a gift. They're a warning. If you've ever looked at a juicy monthly payout and thought, I could live off this, you're not alone. But Munger believed those exact stocks often hide the biggest traps. Munger used to say that investors get into trouble when they focus on income first and the business second. And that's what many high-yield monthly payers are built around: eye-catching yield, weak fundamentals. He warned that when a company is paying you 5 to 8% every single year and doing it monthly, you have to ask a simple question. Where is that money actually coming from? Because here's the truth Munger repeated for 50 years. When a dividend looks too good to be true, it usually means the company is struggling, borrowing, or slowly bleeding its balance sheet to keep investors interested. Charlie Munger and Warren Buffett preferred businesses that grew cash flow, not companies that sliced off cash flow to appear attractive. Munger avoided high payout ratios, weak earnings, declining free cash flow, REITs or funds that raised money just to keep paying dividends. He said that investors get seduced by the idea of income today, while ignoring the possibility of losing principal tomorrow. His philosophy was simple. If the business isn't safe, the dividend isn't safe. A 5.8% monthly payer becomes meaningless if the stock drops 40%, which is exactly what happens to many high-yield plays over time. Fast forward to 2026. With interest rates, slow economic growth, and shaky real estate funds, Munger's old warning is more relevant than ever. Some monthly payers today yield 5.8% or more because their stock price fell. Cash flow is tightening. They're distributing more than they earn. They rely heavily on debt. To Munger, that wasn't income. That was a symptom of risk. He often said the best investments grow your money quietly, without needing flashy yields to get your attention. That's why he preferred companies like Apple, Coca-Cola, or energy giants with strong cash engines behind them. If Charlie Munger could give one message to dividend investors in 2026, it would probably be this: don't reach for yield, reach for quality. Because the truth is, steady dividend growth from a strong business will beat a shaky 5.8% monthly payer every single time. Your salary can be replaced, yes, but only by companies that can actually afford to pay you for the next 20 years. If you found value in this breakdown of Munger's philosophy, consider subscribing. It helps the channel a lot, and we dive into simple, timeless principles that protect your money.